Okay, so there you go. It is recording, and we'll see what we're going to do about the sharing after. But for now, we'll kind of just get into it. Basically, wink, wink, in the coming future, I expect the TAE chat to have an influx of futures traders, and I'm basically running this to not only give you guys a bit of a competitive advantage in terms of learning another instruments to trade off of, but it'll also help you guys keep up to date with what I, myself, Harry, and Jay might be talking about when we're referencing futures trading, okay? And so what are futures? The traditional definition can be found here. I'm not gonna read that, but it's there, it's the official definition. But basically, due to the fact that myself and the majority of us are primarily day traders, our time frame allows us to view them more like a highly leveraged stock. And so, for example, let's take our favorite Apple stock. Pretend it's trading at 145. If we buy one share and the stock goes up to 150, that's a profit of $5. There's a very simple relationship between our entry, 145, and the potential profits and losses as the instrument moves. There's simply no extrinsic value going into our position. It's a constant move up and down, purely price action. Make sense? So some basic guidelines, ES and NQ futures. I primarily trade ES and NQ, aka the S&P 500 and NASDAQ. And so here's some basic information below. In terms of ES, the contract size, the contract is the E-mini S&P 500 index. There is a tick size and a point size, okay? So every point is equivalent to 4 ticks. Each tick is valued at $12.50. Therefore, we can say that 1 point is the equivalent of $50. To maintain this contract, it's 11,000. And the nice thing about futures is that it trades 6 p.m. every day, except Sunday, 6 p.m. every day, all the way to 4 p.m. close, and then at which there's a settlement period. The trading days are Sunday through Friday. And so for the NQ, the E-mini NASDAQ 100, again, it's the same setup. There are 4 ticks per point. Each point is valued at $12.50. Each tick is valued at $5. The maintenance fee is larger because it's a more volatile instrument, starting at $16,500. And same trading hours and same trading days. So there are also micro versions of each to utilize, and here's some basic information below. So there's the micro ES and the micro NASDAQ. Basically, if you divide the ES and the NQ values, you divide that by 10, you'll end up with the correct results for the micros. So the ES contracts, or rather the MES contracts, those can be found as E-micro S&P 500. That tick size is $1.25 per tick, resulting in $5 per point. The maintenance fee is divided by 10. Yes, you are correct. I'm trying to edit that.
No,
I don't think you edited on mine. You are correct. The value point is $20 per. Uno momento. So copy paste. And so moving forward, okay, so the nice thing about futures is that, again, it's a linear relationship. So Eugene Yang asks a question, your account has to be 16.5 to play NQ. That is the maintenance requirements. However, each different brokerage has different margins. Therefore, the leverage you'll take on is going to be different. I will get to that momentarily. But in terms of the maintenance fees, yes, you will need some sort of equivalence of $16,500 to hold one NQ contract. Now, with all this being said, we have the main takeaway is it's $50 per point on ES, $20 per point on NQ. And basically what I want to break down is what some of these trades I've been taking this week can look like. So let's take a look at one of my trades I took under these baselines. I pretty much never show my P&L. I think that's private. However, the MAE and the MFE is all going to result in the same point size based on how many contracts you trade and which instrument. It is 20. I updated it, so if you refresh the page, it should reflect correctly. That was a mistake on my half. I'll get back to margins momentarily, but let's take a look at one of these trades I took under these baselines. I quoted myself, I was expecting a reversal. My line in the sand was NQ low of day, or a new low of day rather. And what this screenshot is displaying is that my entry was based on ES. I took an entry price of 36.90. I experienced 6 ticks of drawdown and I received 100. This was on 0927 within the Tay Discord. And just as a recap, this is pretty much what it looked like in terms of the candlestick position. So long 36.90 at the strike and closed at 37.15. This is a trade that I took on Tuesday in which I was expecting a reversal off of the current lows. It resulted in a net gain of 100 tick core first take profit, which is translated into a 25-point gain. So ticks/points, can anybody tell me what that means in dollar amounts? Here's a quick little chart for me to break it down. So as we know that the ES and the MES, ES is $50 per point and MES is $5 per point. Therefore, a 25-point gain would result in $1,250 per contract on the ES and $125 per contract on MES. Basically what I'm doing what I'm trying to do by giving you guys these examples is to show the flexibility, and this is going to be the first step. I think it's fair to say that many of us in this Tay community have varying sizes of portfolios. And so what I'm trying to express is that there's many different ways that we can enter a same directional play, but utilizing futures instead of options, as well as accounting for the different portfolio values. So let's break this down one more time. With these being said, it was 25-point gain. On ES, that's 1250. On MES, that's 125. Thus, a result of risking no more than 4 points, which is my max stop in this trade idea, this would net the trader a 6-to-1 R result. If the user was utilizing ES to trade this idea, they would be risking 200 to gain 1250. And if the user was using MES, they would be risking $20 to gain 125. Okay. TLDR. So Theo says to everybody, TLDR, you get no theta burn with futures versus options. So this trade is profitable with futures, but not options. Yes. And that's what I'm trying to express. Obviously, the game of options and the game of futures is vastly different. And I'm kind of here to moderate how we could possibly take some of Harry's trades and slowly transition into the futures world. But keep in mind, futures dips into your full account. Yes. Huss says futures dips into the full account, and I'm again going to reference this. So the importance of stops. This is probably the most important thing I need you guys to grasp moving forward. And so first, I'm going to break down the importance of stops as an option. Okay. So most of you guys are trading options right now. And as you know, when a trader is trading options, the most a trader can ever lose is equivalent to the price of the contract. For example, if Trader Joe buys a 0D contract, a 0D SPY contract at say $1, and he decides to walk away, the absolute most Joe can lose is the initial contract price of $100. It does not matter how much price goes against his entry, the maximum he will ever lose is $100. Okay, that's options world. Now let's express this in futures. Futures is very different. You have to trade with stops. So let's use the same scenario, but with Trader Joe, instead of entering a SPY option, he enters an ES position. He's going to take the same entry at 3,600. And as price fluctuates around his entry, Joe is gaining and / losing as long as he's in that position. Both his gains and his losses are unlimited. Okay. So let's say Joe's entry of 3,600 has no stops. Price falls down to 35.90. This means Joe is currently offside by 10 points. 10 points is 40 ticks, which is the equivalent of $500. Thus, this current trade example would equate to losing 10 points or 40 ticks or negative $500 per contract. As prices continue to drop, actually, I'm going to take a quick moment to remove these lines. Sorry about this. Okay, someone else deleted it, but let's try not to draw on the lines. So yes, as price continues to drop, so will the value of the position. This loss can grow indefinitely or until Joe's broker liquidates his position. This is why trading futures is extremely recommended in fact, this must have to have stops. Basically, what I'm trying to express is if you don't trade with a stop, your position will continue losing value until that this will vastly or seriously affect your portfolio value. Obviously, as you can see how quickly you can lose $500 off of a negative point drawdown move. That was only off of one contract. This will multiply as you clip into more and more contracts. So I just want to move forward onto the next sequence of this. In this market, again, the most important thing I'm trying to express is that there's a lot of ways that we can take advantage of people in the TradeAtEase community's ideas, right? Some people like to play in an options case, and they like to have a capped risk. And as price may go against them, and as that happens, their interpretation of the market may still be valid, thus allowing them to kind of add into the position, which would eventually result into changing your average entry and potentially into a profitable trade. That's not how I like to trade it, particularly because I started and learned and grown within the futures market. When I enter a position, I need to have a defined stop that will never move. And if I still like the position, I simply just go in again under the same stop or smaller. But it's a matter of, I like to express it as I'd rather take paper cuts trying to catch an idea rather than adding into a position because I understand the importance of futures and stops.
Hey, Seth, I want to interject with a question. Kind of bring this idea to life that you're talking about, trading futures and how you can have, a plethora of approaches, to this trading strategy. So for example, if you send this alert and you want to try this futures, play, let's say that position you mentioned earlier, you're long with a tight stop, and we want to translate that to the options world. So for example, you take a couple of contracts, your stop is, let's say, just for the sake of numbers, 5 contracts, the most you're willing to lose is 1,000 in that trade idea. For example, if I haven't made the switch to futures, but I want to leverage something like SPX, how would you recommend that I could play that same trade or trade idea using SPX? So for example, if I take an SPX contract, positions or total position size is $1,000, my loss is capped on that. So technically I'm risking the same that you are on that same trade idea. So at what point would you consider that trade invalidated, or would you recommend having stops? Kind of how, the real question is, in what other ways can we leverage your trade idea with options, and how would you manage that drawdown or position size?
Right.
It's kind of a loaded question. I set you up, but just your insight on that. Yeah,
I mean, there's different ways to play it. And I guess in options, I'd rather just leave the position. I guess it depends on how you size it. Okay. So I'm going to use the example coming from the TAE community at which you're sized for 0. And so if you're sized for 0 on, let's say trade idea 1, and it goes offside and the futures player stopped out. However, the futures player comes back in at a better price towards their idea, at which maybe the options player would have to either average down and clip twice into the same options contract, or potentially just open up a new options call strike that would better fit the expected move. Because, as your initial entry might have gone offside, maybe your target has changed to, I don't know. I guess it's hard to say in an imaginary example, but you either just clip in again or clip in again on the same contract, or try another long strike.
Makes sense.
Okay, so I mean, I think it'll be better expressed if I go into this example. That's a tricky question, so I'm going to go ahead and start that. So what I'm trying to say is that there's many ways to skin this cat.
Okay, so look, for example, 3,600. You long one ES contract with 4-point stop. You're risking $200. Now, you place, if you want to trade trade options the way you trade ES with the same risk, you would place okay, I would place $1,000 into a trade with risking 200, right? So my stop loss will be -20. That would be the same as $200 on one contract with 4-point stop. So both trades, you risk 200. One's options, one's futures.
However, the difference is the options player is still going to be in position. Even if it goes to 0, maybe it turns back.
Not if, okay, ES player stops out for -4 points.
Mhm.
That's $200.
Mhm.
-4 points on 0 date probably give you -15, -20. So $1,000 trade going -20%. I mean, -4 points on ES will probably give you -15, -20 on options. So you're risking 200 for both, but one's options, one's ES.
Yeah. Yeah, it's hard to compare. Yeah, certainly Sleepy. It's very hard to compare futures versus options. 4-point stops on ES will cost you 200, but options -15 or something. It's hard to compare, and this is pretty much why I'm trying to express the same idea, but just on futures. I understand that some people may not. Geez, I lost my train of thought on this. Sorry. I'm just going to go back to my scripts.
Yeah, no,
Yeah. So what I want to say is that there's many ways to skin a cat. Some traders utilize tight stops, some use scale-ins, some would prefer scalping, and some swing. And all of these can be expressed in futures and options, but I'm here to express it in futures. And so let's just break this down really quick. For example, let's say Joe wants to risk no more than $1,000 on any trade idea. Like you guys are coming from options. You guys have a cap risk at 1,000. Let's take a look at what that might look like if it was expressed in futures. Now, under this example, this is assuming that Joe decides to clip all of his intended size at one price. So we have this entry of 3,600, and let's say that he clipped in with one contract. This would mean that under one contract, he has a -20-point stop to respect his -$1,000 stop loss, thus resulting in a price of $35.80 to trade for Joe to be stopped out under one contract. I've prepared this image really quick. And if we just take a look over here, entry at 3,600 at -20, he would be stopped out. This is the range he would have to work with, okay? Now, moving back. Here we got the next example. Let's say that he clipped in with two contracts. This would result in Joe having a -10-point buffer to respect a -1,000-point stop out. Again, this is what it will look like. Obviously, it's going to be a tighter range. -20 is half, or sorry, -10 is half of -20, obviously, because it's a linear relationship between futures. And so the last example I want to just go over is, let's just say Joe really wants to clip in this idea. He wants to go in with 5 contracts, and he still only wants to risk $1,000. This would result in only a -4-point wiggle room for Joe to work with, resulting in $35.96 to trade to stop him out. Now, let's take a look at the different ways Joe can express this to futures. This time, the first idea we said that he clipped in all at one strike. This time, let's take a look at what it looks like if he were to scale in his approach. So let's pretend that Joe wants to enter at 3,600, he wants to enter at 35.95, and he wants to enter again at 35.90. He can do that all the while still respecting a -1,000-point stop, or sorry, $1,000 stop. So really quickly, if assuming Joe gets his full clip in, his average would then result in a 35.95. His contract count is now 3, and he would have a -12-point stop out from his average, thus resulting in 88s to trade to stop him out. What this might look like could be something like this. He has an entry above, entry at 0, and entry -5 to scale into an idea, resulting in a -12-point stop after 3 scale-ins as his buffer. Oops. Now, on this idea, Joe decides to scale in utilizing 3 entries. Assuming Joe can get his first scale in, his new average price would be 35.95. Let's take a look at some simple math. Because Joe had his first entry at 3,600 and his next scale in was planned at 35.95, this would mean that his current position at second entry would be one contract experiencing -5 points of drawdown, This would result in negative $250, where he would enter his second lot at 3595. When he enters a second scale in, his new average would then be 3597. By the third and final scale in, with his two previous entries, that means his first entry is experiencing negative 10 points. His second entry is negative 5. This would result in negative 750 by the time 3590 comes by, and his third and final scale in as well. With these three lots flipped in, Joe would then have a further 2 points of wiggle room as remaining, as an offer of 3588 would cause a scaled in position to be offside by negative 1050. So with these examples shared, I hope we can understand the flexibility of futures contracts can have to allow a trader to express their idea at many scalable approaches. The above examples are utilizing a $1,000 stop and only reviewing ES scenarios. By using micros, MES, you can essentially have 10 times wider stops as the above example, or more scalable ads and profit targets. It's a beautiful thing being entirely flexible with the most liquid instrument on the market. Again, I want to express that these have no extrinsic value, and so it's exclusively linear. The market can trade sideways for a day, for an hour, for a week, and your contract will still be relative to your entry price. So I'm going to take this quick moment to answer some questions before I jump into the next sequence of Babel 2. And I'm kind of just going to go through all the questions. Where was I?
And for you guys talking about leveraging the sentiment and the alerts, like with options and futures, that's what that next Babel will cover. So we won't answer questions about leveraging the alerts because the visual will speak for that. But anything outside of that? I think you can just continue.
I can pretty much continue, but I'm gonna let a few chances come in. So are there any charges for overnight swings? Again, that's going to be related to margin. I'll be covering that lower. But basically the quick answer is when you're dealing with futures, and let's pretend that you are leveraging margin, you have to be aware that your broker will have a day trading margin requirement. And this will change to a larger requirement as it goes into settlement and ETH if you want to hold overnight. So again, that's going to be like, I can't have a formal example because each broker is going to be different. You kind of just got to go and take a look at what your broker's requirements are for that. Are the future stops like a trailing stop? Future stop can be whatever you want. There's no such thing as an exclusive trailing stop. But I'll get to that again in terms of position managing in the future. Okay, so I don't have many actionable questions right now. I'm going to carry on onto the next sequence of this. And so Babel 2, right. So under this scenario, this is pretty much why I skipped some of the questions. This can basically translate into how one may execute off of Harry's sentiment, like the general overall sentiment on the market. But instead of expressing it through options, I would take a look at how it can be done through futures. And so on RTH 0928, Harry's alerted. Let's focus on this SPY 923.366 put at $1. Right over here, we have a 15-minute chart, and at the line and the time, that's basically where Harry alerted it. As some of you guys know, we can clearly see it was a profitable trade for up to 40 points, but there were some clear points of consolidation and or auctioning / sideways action that may have shaken out some traders in the room. And so I want to take this moment to do some quick analysis of the situation. Of the session. So these are my notes. Under this, this is a 15-minute chart. I'm pretty much going to go over step 1, the market open test drives down and meets liquidity. Step 2, the point of liquidity is titled auction 01, and within this auction, Harry calls out puts. The down move is granted and puts are profitable. Number 4, bounce comes in and auctions further into auction 2. Market goes offer once again, and new lows are found, followed by a short covering rally into close. So as a sidebar, I want to reference sidebar reference number 3. I want now within this point of new low of day, I'm sure that there are some traders. Okay, actually, I want to go over this one more time. So sidebar 3, reference 3. The down moves granted and puts are profitable. What I'm referring to is this second arrow here. So now within this point of new low of day, I'm sure there are some traders that would have taken their gains and waited. And the lows are now set at 36.75 and a bounce comes in, followed by auction 02. As a sidebar, I want to just talk about how many of you guys are guilty of exiting a position, but Harry's still in, and later on in the day, that position is now 2 or 3 or 4 baggers, right? Plenty. Now, with this idea in mind of further selling, it's up to us to find a way, those who exited the position, to access the continuation of the trade, but perhaps maybe risking the smaller position size. And so this is why I want to talk about futures in sidebar reference 4. So I want to talk about this bounce. So we understand that sideways action is the death of an options contract, especially 0Ds. Maybe due to the auction seen above, this may give some clues of further auctioning before continuation of the move. Reference auction 2, which is found here. Again, this is a 50-minute chart, so obviously you can see that we spent a lot of time going sideways. This is where I want to talk about futures. Futures, as you know, is not influenced by Greeks. It's strictly price and price action. So let me take you through a structured trade idea through the lens of futures using this session as an example. And so again, this is pretty much the recap. Let's just take the idea that Harry entered a position. It was profitable. We had a dump. We closed the position, and now the market's trading sideways, and we still want to go. Okay, so that's where we are in this idea. And here's some key points that any user can pretty much figure out. So again, this is the session. The original entry is found at 37.05, marked by the purple line. The current lows, pretend that we're auctioning within this box, are currently set at 36.76. This would mean that the swing high is located at 3,700. And so total range of this entire idea from pivot to lows is a minimum of 30 points to work with. And the total range of swing high to lows is 24 points to work with. So now, here's a couple things that I want to go over. So let's establish a direction. Many of you guys are in Harry's room, so let's use it as an example. So, Harry is still short, and we're following his alerts. So the direction I want to choose is short. Next, we have to establish, again, because this is going to be done through futures, it's important to establish where you may have a stop. In this, I want to have 3 stop ideas. So stop idea 1, a trader may have a stop. So
Hey guys, all questions, use Leverage a trading chat room. So I'll be going through there and then we'll pull this up as well. So trading chat for all questions now. Thank you.
So let's have some user input. The direction, we're going to play shorts. And where do we want to have our stops? I give you 3 for this breakdown example. Stop idea 1, the trader may have a stop above auction 01 highs. It's rather wide, but again, we have to structure a trade plan around it. So auction 01 may have a stop above 37.17. Stop idea 2 may have a stop above the line of sand, which is Harry's original entry, 37.05. And stop number 3 idea, a trader may have a tighter stop above swing highs at 3,700. Let's take a look at what that might look like. So assuming you guys are active traders, I can see several reasons given the short bias. A lot of you guys might be able to sniff a possible entry around the 36.95 entry. I'm not asking you to top ticket. I'm not asking you to sell into the lows. It's just from a chart basis and price action. And I know for a fact order flow, it's reasonable to have you guys enter a position for a re-entry short at 36.95, right? Like we have, there's plenty of reasons to come to a valid entry at 95s. So assuming we clip an entry to short 36.95, we can start to manage expectations or starting to plan around our trade idea, right? If we enter here, we would be expecting the lows to at least break bare minimum. With an entry of 36.95 and a TP of 36.76, which is the current lows, we are essentially accounting for a minimum of 20 points to bank. We can now formulate potential grading of trades. And so let's take a look at what these would result in, assuming these lows break. Trader 1's entry, again, these are going to reference the same stops from above, up here. So Trader 1, who had a stop at 37.17, they would be essentially risking 22 points to gain 20. This is only a 1-to-1 R. Trader 2, however, this is when you start to see these multiple R's multiply. Entry at the same entry with a stop that is tighter at 0.6s, they would be essentially risking 11 points to gain 20. And trader 3 with the same entry and an even tighter stop would be risking 5 points to gain 20. Again, now this would result in a 4-to-1 R. 20 points is the equivalent of $1,000 per contract. And so that's that. In hindsight, we can review that the perfect exit at 3660 would net these results. So trader 1 would be rewarded with 35 points. That's a 1.5 gain R. Trader 2 would be rewarded with the same 35 points. This would be a 3-to-1 R, and trader 3 would be resulted with a 7-to-1 R. 35 points under ES is now 1750 per contract. These are super realistic stops, just hidden across basic structure. Super realistic targets, expecting new lows into runners. But the more important thing is that when you enter a futures position, I need you guys to start thinking about plans. My plan is going to be different than your plan, which is going to be different than Harry's plan. But it's important to have your stops and don't move them. It's important to have ideas of take profit. Don't change them because that's only going to skew your current RRs. But having all this set out kind of lets you execute your trade plan without noise, right? Like a lot of us have issues holding on to positions. Well, you're going to be less inclined to exiting early due to sideways market because futures isn't affected by that. It's strictly your entry versus current price, and that's that.
So I want to highlight something that I've learned from you since you've been here, and I think that others will be able to benefit from looking at the market like this, especially trading options. And so right here, we get a Harry alert, short, right? And this is what I mean by look at the chart, guys. If I get it, if you're, just blindly following the alerts and so when drawdown, all those things happen, stay diligent in these trades. There's no reason to get shaken out if the trade idea is no longer invalidated. So let's say we go short here. We got a little bit of noise. We squeeze a little higher above this, or we splash above this level. The trade idea is still no longer, or it's not invalidated. We're still auctioning. In the options market, we call this chop here. It's death to a contract. Agreed, right? But keep in mind at the time of day here, this is 11:30 a.m. There's no reason to be size heavy in this contract and be shaken out for a loss just because we're auctioning. And we got this full move and, and this is 1 p.m. now. A lot of opportunity. So just understand what's happening at these levels and what could invalidate these trades, and don't determine a good or bad trade by initial drawdown, because what we're trying to capture is this. None of Harry's alerts. Like a good trade is 20-30%. That's standard across the board, right? But what we're really trying to capture are these macro trades. So definitely make sure you're TTPPing along the board here, but drawdown in this auctioning phase shouldn't be shaking people out, especially this early in the day, because when you look at it from a futures perspective, we're auctioning. This trade is not invalidated, and then you see what happens from that point on. So shift your perspective. If you're not actually leveraging the futures instrument just yet, I recommend looking at these trades through the lens that Set is showing here, because that'll help you that'll prevent you guys from shaking out of these trades as early as you are, just simply because of the lens that you're using. So
right. And so that kind of brings me into this next one. Many of us may have gotten shaken out by theta and the clock ticking. The beautiful thing about the futures is that the auction 02 could have lasted all day into close. It could have lasted for the next session and the one following that. However, with a down move or a flush, the values are going to still be the same, right? Like whether I entered at 9 a.m. and held all day or entered at lunch and held all day, as long as the take profit was 62s, that value is going to be the same. So, just once over, super realistic stops, super realistic targets, plan for your trade. And the great thing about futures is that there's no Greeks involved. Okay. So now we're going to get into the futures and margin requirements, which is such a popular question in this chat. So before I do that, I want to just make sure I'm not missing any key questions. I was wondering why the area between the auction low and break of current lows isn't considered the auction within the box. That's not considered within the auction for me. And that's going to be strictly from an order flow point of view. I think I can dive into that after class, but for now, let's just stay on topic. Can we set a fill order at specific price for futures? Yes, you can. So when let's say you want to buy let's say the market's trading 3,600 and you want to buy lower. You simply just set a limit and limits to buy at that price. I have great entries, most at least. The problem comes with losing money when the trade runs without me. Now SPX is getting better with giving me good profits. Not related. More attention to consolidation. Yep. That's it. Blue boxes.
At the end, can you just go through your journal and just briefly describe your chart, like the volume profile? I
Okay.
think that's a common question. That's just like a quick.
I don't know how many blue boxes in my chat.
I don't know. Blue boxes? Or is that door? I don't know. All right, we'll get back to this.
Oh, the footprint chart. Yeah, I'm not going over that right now. Okay, so how to access futures and the margin requirements. Most of you guys are using brokers that probably have access to futures and futures data. It's just a matter of requesting it. Thinkorswim, Interactive Brokers, TradeAtEase, they're all valid brokers. Each would have their own minimum account balance requirements, margin requirements, and overnight requirements. So there's not really one shoe fits all scenario. In fact, there's even discount brokers, which I have to press extreme caution, beware, because this would allow a trader to leverage a minimum account balance of $500 to execute a ES contract, which is crazy. Just be aware that if margin isn't always a good thing, okay? So this would, if I were to enter a position that was allowing me to have $500 to manage one ES contract, this would essentially mean the user is utilizing $500 to act as 11,000. That's AKA the fastest ticket to automatic liquidation. So in my opinion, I always like to say small and slow are going to be your best friends. There's time to press into a trade. And in my opinion, if you have under 5 years of experience, you don't even know when. So just grow slowly, and play the long game. But that's just my opinion. I have my own beliefs, my own methodologies to the trading game, but that's a whole other topic. So, for example, okay, so this is a quote taken from TD Ameritrade. For example, if an E-mini S&P 500 futures contract has an initial margin requirement of 6,600 and a maintenance margin of 6,000, buyers or sellers must have 66 in their accounts to enter the contract, and they need to keep at least $6,000 in their account to stay in the position. What does this mean? This is basically stating that they will allow a trader to utilize a single ES contract given their account balance is above 6,600. They will, however, liquidate your position if the account balance goes under 6,000. This means that you can have a $600 stop before they will close the position themselves. Margin, again, is a double-edged sword. You're allowed to borrow the excess dollars, but your balance must meet a minimum requirement. So just for a quick quiz, can anybody tell me how much $600 stop is? Spoiler, it's right there, 12 points. What that means is on a single contract, at a single contract with a balance of 6,600, you only have 12 points of wiggle room before they automatically liquidate. And in today's market volatility, you could be out of that trade in minutes, but that's just a thought. Uno momento, on to the next sequence.
The announcements channel is gone. I'm dropping the link here for you guys. And so there, the link. All right. Gotcha.
So in terms of future symbols, a lot of people are asking me about what is the correct symbol to use. And so the first thing to understand for this is kind of getting into the weeds a bit, but it's a common question, so I felt like it had to be answered. First thing to understand is futures contracts have an expiry. Just a matter that as day traders, again, they typically don't matter. However, at this point that the contracts do expire, there's a period that we would refer to as rollover. Futures will roll over in December, March, June, September. Right now, we are currently trading ESZ22 with the recent expiry of the September contract, ESU22. How to format it? It's basically December is our Zs, March is H, June is M, and September is U, followed by the last 2 digits of the year. All the futures contracts, i.e. the next contracts, all of the future futures contracts, i.e. the next contract, ESH23, March 2023, are tradable. However, the liquidity and the spread will be very different than the most current or the front contract. So the question is which one to trade, right? I will always trade the one with the most volume, but as it's important to note that as futures rollover date approaches, traders begin switching over before it actually expires. Because of this, the flows will be divided and the order flow is essentially split up. This contributes to one of the reasons why I don't trade near rollover dates. So Babel 2, this is the part of the conversation that branches off into a bit more freestyling. I sent a request within the Take community to ask me questions that could be answered. And here in this segment, I'll be expressing my personal opinions and recommendations. Nothing is set in stone, but feel free to ask about it further in chat. So the first and most asked question is, how much is required to trade a futures account? And to that, I will say A, it would require the minimum amount set by the brokers. And followed by that, I'd recommend B, that anyone that has a portfolio size of under 10,000, I would highly recommend to exclusively trade micros. This is, i.e. the smaller version of the ES and Q futures. And it's important that whilst doing this, you are staying under 10 contracts max. Why a max position size on micros? Because again, micros are just 1/10 of an ES contract, of a mini contract. And so it's kind of just cheating if you're breaking the simple recommended rules of having, okay, I explained it here. Why a max position size? Because it's simple math. 10 MES contracts is equivalent to 1 ES contract. So you're essentially breaking the rules or recommended rules if you're trading a $10,000 portfolio, but trading 50 MES contracts. That would be, again, the equivalent of 5 ES contracts. Second, I have a lot of people asking me how much is good for daily gain. And to me, you need to start viewing the market in points and ticks instead of the dollar gain. There's going to be no difference making 5 points consistently on MES or versus making it on ES. Once you can prove yourself that you can consistently, once you can prove that you can consistently extract 5 points out of the market, there's no difference whether your clip is 1 lot or 10 or 50. You will not run into liquidity issues on futures. 5 points is 5 points. You just got to build a system, be consistent, and there you have it.
And that's the point I was making earlier with the example on SPX. One thing Seth, preached to me was like, view the market in ticks and points. And so when you have drawdown, cons are down 30%, 40%. Who cares, right? We're only 2 points above our entry, 3 points. Yes, we're auctioning, i.e. chop. So theta is burning the premium contract. You can get out for a loss there. But if you wait, 20, 30 minutes and allow the trade to work out, then that gives you the wiggle room. And so when you view the market through this lens, through the points and contracts or the tick, example that Seth provided, it would drastically change the way you look at drawdown and staying in these positions.
Yeah, agreed. So it's pretty much all that I have for this conversation. This Notion document can, you guys can have to keep. I think I froze. Oh, a little bit of lag. I'm back. Yeah, so this Notion, I've let you guys have the download link. I'll keep that open for at least a week, but it's yours to keep and reference. And I'm pretty much going to be here to answer your questions. Not just today, not just tonight, but hopefully, I'll set some time each day or once a week or however frequent to answer some of these questions, and I'll start to throw the FAQs in the futures chat.
But while we're here, you guys just have any questions really quickly in general? We'll kind of skim through them.
Minimum portfolio size, again, similar to options, that's going to be relative to your portfolio. I just have the hard set rule that if your account portfolio is valued at under 10K, you got to size accordingly. And sizing accordingly would, i.e. mean how many micros do you use? Well, your average clip size might be 2 or 3. And then on super high conviction ideas, maybe it goes up to 6. But it's all going to be relative to your account size, your position size should always be relative to your account size, and your stops, at least while you're growing, should always be consistent. So next question, what are the commission fees for futures? There are going to be different plans you can have. So IBKR and TOS are notably higher on the commission side. And then TradeAtEase even has an option where you don't trade or you don't have commissions at all. It just makes you have a minimum requirement of trades per however often. I don't have the clarification on that because I don't have access to TradeAtEase in Canada. Personally, I use IBKR and AMP, but let's just stick to I use IBKR because I don't want you guys using discount brokers.
I'll provide, you know, like I said, we're rolling out the futures, you know, notion here in the room. So I've told you guys before, I've never traded futures before. It's been only options. And so I actually opened up a TradeAtEase account this week just to kind of see, to play with it. I think it's great for our room as we're kind of trading or transitioning into that space a little bit more to provide some firsthand analysis. So we'll just be uncovering, you know, which brokerages work best, but IBKR for sure, as Seth had mentioned. But TradeAtEase is a great place to start though.
Besides your first 10-point, okay, next question from Eric. Besides your first 10-point target, what is your favorite method to trailing stops and how do you pick targets? Okay, so this is when it gets a little complicated. I personally would give myself the title of an experienced futures trader, and I don't want you guys to, I need you guys to discern this from account growth scenario. So as you guys know, I have an average of 3-point stop and I have a must take profit at plus 10. That already covers my base on 3-to-1 R. But the amount that I trim is always, tends to be a little different based on the conviction that I have on the day. So I typically trade reversals. And so in reversals, you can look to expect 20, 30, 40 plus points, especially if you catch like a significant swing high or swing low. And typically what I look for are these larger moves, but I will always take a piece off at 10 points plus. What is my favorite way to trail the methods? I get pretty greedy, especially because once you go plus 10, maybe not so much in this current environment, like to say this like August to now, 10 points is not necessarily a bottom, but it forms a local high or a local low typically. My favorite methods of trailing is being greedy and leaving my stops a point above entry, like 1 point above entry. The nice thing about futures is that, you know, that price, the value of my contract again won't ever change because it's futures. However, it's different. You'll notice that it's very different if you were to place your stops at break even or small in profit on an options contract versus futures. Because let's say the move goes up, any bit of like sideways action or even a slight reversal, your options contract might hit that break even before it even gets back to your entry, like spot, like the underlying asset entry. So the nice thing about futures is that if I'm wrong, they got to come all the way back down and get me to tell me that I'm wrong. So my favorite way to trail my stops would either A, leave my stops at actual break entry or break entry plus 1, or B, leave my stops under a pivot that price has already crossed. I don't have an example today, but you know that I was trying to fade. I faded once at 01, faded once at 80. I faded an average entry, like a decent entry earlier. Let's pretend that price actually broke through a previous pivot. I would then have my stops placed above that pivot. Next question is, when you have an MAE of 10 points, does it mean you have 5 lots, it's 2-point MAE, or it's always based on 1 lot on the calculation? It's always based on 1 lot in the calculation. When I post my pictures, that is shown in ticks, not points. And yeah. And
then Trade Planner, the plan to call out specific futures contracts and entries. Yeah, so the plan on alerts, they're only getting better from here. And so there will be a new approach. So it wouldn't be primarily focused on futures and options. We're providing the sentiment, and then through either Harry or Set or whatever the case may be, there will be hand selected contracts, whether it be futures or positions, and then contracts from Harry. So we will be leveraging both more to answer that question.
So, you know, you guys seem to be talking about swings as well. So, you know, I'm not going to go into detail about this right now, but it would be nice of me to give the hint that futures can really help your options swing positions. And this is something that I do. This is something that my mentor taught me. And the idea is that let's pretend that we're in a swing puts position and it's profitable by like a day's range. And the following day comes open and our puts are in profit by like, let's say like 40 points, like a full day, right? Nothing's stopping us from holding those puts, but playing long futures against it. And actually, I guess that's one thing. You could play long futures against your current options positions and vice versa. But the more important thing that I really want to express is this. How many times has Harry alerted a position? Let's say that at close, he enters weekly puts, right? And we track that Globex open 6 p.m. EST, and he, price gaps up. You're offside by 10 points. And many of you guys just be like, oh, these puts are dead, blah, blah, blah. Nothing's stopping you from going long futures against your puts position, right? Like that's essentially a hedge. And the nice thing about futures is that you could be you could hedge against yourself, and the price can go sideways the entire night and then like spike in a direction. And that value of that futures contract is always going to be the same. Like there's been days where my hedge, I would maybe fall Harry and then I entered a hedge, and that hedge covers the entire cost of my offside position that's under options, right? And then there's times when I've added into it, like let's say that my hedge turns profitable, and then I close that futures position and flip the opposite directional bias and just add into it at a better price. Like the futures market is open 23 hours a day. There's no reason that you can't play against your open offside position of an option that's, not even open until 9:30 the next session. Circumventing buy longer. I'm unable to trade the whole day to catch 10 points. Is there a way to catch the bigger macro move in futures? Yeah, I mean, like you can just if you can't watch the whole day, the futures market is almost always open, so there's macro moves to grab, period. But B, a thing that I like to do is set a bracket order under your broker. So what that means is no matter what, when my position is filled, it will automatically place a stop and a take profit OCO, order cancels order. And so let's say that I'm unable to be at the screen, but I really like this price, but price currently isn't trading there. It's trading like 10 points higher, right? I can place a limit order on that, and attached to that limit order will have an automatic bracket. And so if price trades down into that area, it will automatically have my stops and automatically have my take profits, and it'll all be managed for me. I just got to, ensure that my price gets filled. Books, videos, learning materials for volume profile, footprints, and price action. Yeah, there's plenty of resources online. The one that I always recommend is Auction Theory by Dalton or Steidelmeier. I definitely recommend you guys to get some footing on that. That's going to allow you to view the markets more similar to how I read it. To be honest, I'm down on costs. Shockwaves is asking me to break down the terms here. So sell 37.17 and sell 11.409. So the action that I took was a sell order. So I had limits to sell, or I definitely had limits to sell. That's how I enter, but limits to sell 37.17. That was my entry. What happened then was I was offside by 6 ticks. That is MAE. That's how much your position was offside by. And then MFE is how much maximum your position was valued at. So my MAE was 6 ticks, my MFE was 38. And then obviously, I mean, it's not obvious to people not trading futures, but 11.409 is the NASDAQ futures instrument at which I was offside by only 3 ticks to gain 45.
So you're him.
Sometimes. what other guys? Yeah, so like again, I use a bunch of things. I use like option sentiment. I have a couple algos. I mainly use order flow and auction theory or market profile. I mean, like, I'm a resource for you guys. I'm here for Tay. I'm sure there's ideas in the future to have some more depth into what is order flow and what is auction theory, but it's kind of like, well, I'm kind of in between because you guys are an alert service. Not all of you guys are here to learn. I got to figure out like what I want to do, but there's definitely good things coming in the future. Reek said that there's gonna be resources tailored to how we trade. Yep. Bracket Moa Reggie is showing you a bracket. Thank you for that. That is what TradeAtEase bracket setup looks like. And so what that can, but essentially this means is that in this example that he has in the trading chat, his price to buy is at 1019.75. And attached to that bracket, he plans on having a take profit of 30 with a stop loss of 15. That's how you set up a bracket order. Super highly recommended. It's how you have longevity here.
Nini says future trading platforms look a bit complex. I agree. And if you're new to trading options, it's all the same. Like when you think about it from like options, and I told you guys been very transparent. Haven't been trading as long as these guys, you know, the big bros here in the room. So when I looked at an option chain earlier this year, I was like, what the hell is going on? And then as you start to find the parallels, and the same thing, if you are familiar with options and you're starting to transition into the futures trading world, now I'm not sure if you're already looking at ES and NQ when you're placing SPY and QQQ and Apple trades, but start looking at the levels that we're at on ES. For example, ES moves 10 points, that's $1 SPY, you know, and I believe these numbers are in here in the notion, but look at how the futures market moves the options that you're trading, and then it just goes down to you understanding how to place the order on your broker. At the end of the day, you make money, you know, understanding the sentiment, understanding what can happen, you know, the direction, and all this stuff is synonymous, to be quite frank, coming from a newer perspective in this space.
Yeah, I mean, like the key thing is you want to leverage your current learnings and understandings and just translate that the best you can into ES. Like, right, SPY and ES are going to move in tandem, like no matter what. It's a derivative of each other. And so once you understand how SPY moves, you'll understand how ES moves, and then you can translate to how that potentially can affect your options contracts. The underlying concept I'm trying to preach is that the ES is always going to be linear. Here to learn, So futures is going to be more risky. It's more leverage, right? Like obviously buying the actual stock is going to be even less risky than options. There's like a chain of command. However, we're trading period is risk. And so if you guys are going to take it, you at least do it on appropriate sides. The videos for beginners, there's really no need for beginner when you have this document. Just go through it again if you need some help. And then it's a matter of understanding your broker. I don't have access to many brokers being a Canadian, so I can't really give you guys a walkthrough, but figure out how to set a limit order, buy order, a bracket order, a stop, and a take profit, as well as market orders. It's pretty much all you need to know.
Yeah, you can YouTube the brokerage. How do I put a stop on TradeAtEase, et cetera?
Yeah.
Just we're teaching you how to leverage an instrument, and then the brokerage part, that's easy work.
Yeah. Yeah, I prefer to use, again, my futures are my bread and butter. I leverage options when I have like lotto ideas or some crazy ideas, or I'm just simply here to follow a friend. But what I'm similar to Harry, we're all size for zero because I'm primarily a futures trader. I don't know what I'm doing in options. So I just set and forget. And the capped risk is the nicest thing about it. There's been days when I've swung an idea into close, or like I bought an idea into close, and then it doesn't even matter what happens in the overnight session because 9:30 print stealing is when it resumes.
Harry.
All right, so this would be the intro to futures. This is all under the Notion doc. I will repost the PDF if it's missing from whatever's going on, but happy to be here and I hope this helped.